Good morning, everybody. Hey, it is Tuesday, February 28th. Welcome to the last day of February 2023. Hard to believe, isn't it, that this year is flying by. Hope your week is off to a great start. As we get ready to talk to Dave, we did end up, I think, in the green yesterday. We'll talk about that and more, and a few earnings reports we had come in overnight, and we'll talk about that in a little bit. But hey, look, like I talk about every day, the closer and closer you get to retirement, the more and more you need to be recognizing how much risk you have in your portfolio. That's exactly why I developed the core retirement design to help folks design the retirement they always dreamed of. Give us a call, 863-382-0037 to schedule your core retirement design. Love to help you out with that. If you're 5 years out from retirement or closer, or if you've already retired and you've been retired for less than 10 years, that's the window that we need to be looking at when it comes to risk. It can play a vital role in your retirement planning. Hey, with that, we got Dave coming up next.
5.7 Light FM, the original Lady Gaga hit, Born This Way. It's 8:40 now, 20 before 9. Time to check in on your money and see what's going on there this morning. Believe it or not, we actually had a green day yesterday on Wall Street. I asked Phillip Statler where the heck went wrong because we're green this morning, too. Let's go downtown to the offices of Statler Financial Services and see what the take looks like this morning. Phillip, how are you today?
Hey, I'm doing well today, Dave. It's still hard for me to believe that this is the last day of February. How about you?
It really, just the month went by way too fast, unless, of course, you had money at risk, in which case you're probably saying, thank God it's over, right?
Exactly, because I read a couple articles, basically February gave back most everything that they gained in January. So it means that it was a rough ride for February. And, one of the articles said, hey, look, we are right around that 200-day moving average, and we need to stay there in order to bounce up. And so if we break that plane and go below that 200-day moving average, then that's not going to be good for stocks. The other one I saw was from October till now, the question is, are we in a new bear market, or is this one of those bear market tricks, right? We think a bull market. We're in a bull market. Is this one of those bull market tricks where we're really not in a bull market? We're just going up during this bear market before we fall again.
I'm still kind of half expecting this thing to be kind of the off tick on the way out of a bear. I don't think it's going to go all the way down to its lows, but my expectation, just looking at the charts and looking at history, I'm not calling it a bull by any measure yet, although I do get a kick, and I've been making fun of this for quite some time. The young columnists on the online news services talking about the first quarter rally. Will it continue? Well, for the last 28 days, it hasn't been there at all. So the question is whether it's going to continue might be a whole different story. Yesterday, just to set the table, it actually was an up day, although not by very doggone much. Dow was up by 79, which is 0.25%, but at least it was green. About the same percentage on the Standard & Poor's, up 8 3/4, and the NASDAQ was up by a smaller percentage this time, only up 19 1/4. But the good news that you got to bring out is the fact that, for heaven's sake, finally, it was green ink for a day, wasn't it?
Yeah, it was. And that was good to see that we did finally see some green ink across the board, because it had been a dismal week or last week was a dismal week. And the question is, can we end up on a positive note on this last day of February? And right now, it looks like we could start out that way, but we're really on shaky ground, and it won't take much for that to falter. Actually, we're getting really close to going red right now, Dave.
Gosh, thanks. I'm glad to hear that. You got the current quotes. I'm working at delayed quotes, and they're still just marginally green this morning on my delayed quotes. It's been a rough month when you have J.P. Morgan putting out a statement. One of their economists said, if you want a good investment, you really ought to try doing savings accounts, because the Treasury bills are bumping their nose close to 5% when you start getting 4 3/4% yields on the 2-year Treasury notes, and pretty close to that on the 3-month notes. That's not even tying up your money very far. And when you start bumping your nose on 5% returns, that's starting to look like a pretty doggone good investment in light of what we've been experiencing on equities.
Yeah, and that's true, Dave. I'm starting to see some local credit union stuff hit like a 4% number right now on savings and CDs. So that's good. But around the world, we've seen banking really start to take off in this last 12 months. Every time the Fed raises interest rates, they've raised their interest rates. So that's been really good. I mean, I finally found some rates for corporate stuff around 3.5, because it's harder to find corporate savings rates that mirror individual savings rates for some reason.
Understood. Yeah, and it needs to be noted, too, that we haven't the standard issue passbook savings account, the on-demand account that people put and take from. That really is about the only instrument that really hasn't gone crazy yet. You buy a CD that'll hold the money for a little while, you can get a pretty good return these days, but passbook accounts are still frittering around the 1% mark yet. So we haven't exactly floated all the ships with the rising tide, have we?
No, we haven't, and that's why if you go out there and look across the board at some of the online banks that are FDIC insured, they do have some savings accounts that will get you in the 3.5, maybe even a little higher rate.
Yeah, I see them online and the promotional offers from the accounts. But you go to the local banks and it's not just our local banks. I'm not dinging them, but the on-site brick and mortar banks that we're likely to walk into, still you're looking at 0.91% interest rates on passbook savings, and it kind of makes you do a what the heck moment there. But got to keep in mind those accounts are high to maintain. Number two, they tend to be small balances, and number three, you can take out as much as you want whenever you want, so the bank doesn't know they've got it for any length of time. But boy, if you'll commit to 2 years, you can get a rate that's pretty impressive these days.
Even less than 2 years, Dave. You can go to a year now and still get some impressive rates.
Oh, yeah. With the 3-month Treasury notes being at 4.725, the bank can afford to do something halfway decent these days. Morning data dump. It's probably not going to be major market moving stuff, but just to keep everybody informed, we're still buying a whole heck of a lot more from overseas than we're selling there. The trade balance went up from $89.7 billion last month to $91.5 billion this month. That's up a full 2%. Number that probably could move the market a little bit anyway are the two inventory numbers, wholesale and retail inventories, which tends to look to me like a confirmation of a slowdown. Wholesale inventories were down by 0.4%. They expected that to be like 1%, 0.1%. Retail inventories, on the other hand, grew by 0.3%. They also grew by 0.5% last month. Tells me that the retailers are a little overstocked and the wholesalers are planning for a drawdown, and that's not necessarily good news in a consumer-driven economy like ours.
No, it's not. But from a business standpoint, it does make some sense, right? That the businesses start to kind of tailor off some of their inventory so they don't get stuck with it. The
wholesale does make sense, but the retail inventory is going up. Tell me that we got a lot of retailers getting stuck with inventory.
That's right. Look for sales coming soon, folks.
Absolutely.
But the other thing that came out, you and I didn't talk about earlier before we went on the air, is pending home sales came out yesterday at 10 o'clock after you and I got done. And they were a huge surprise. I mean, the expectations was an increase of 0.9%. They actually saw an increase of 8.1% in the pending home sale.
That's almost earth-shakingly big, isn't it?
It was. It really was.
Which means the Federal Reserve is going to look at that and say the economy is too hot, and it's one. Yeah, I mean, you see it all coming as it goes. Yeah, I got to make note. It's a federal government giveaway starting today. The process opens today for semiconductor companies to apply for a piece of a $39 billion worth of grant money being allocated as part of the CHIPS and Science Act that Congress passed last year, because we've got so much money, even for something that I think we all agree we probably need to develop in this country. We could afford to give away $39 billion this month.
Yeah, I'm telling you, Dave, that did you see a deficit somewhere in the words? Because that's definitely creating some deficits there, and they got a lot of strings attached to it. But hey, I guess if it helps bring industry back here to the United States and helps build some plants, which helps jobs. And this is an industry that is not going to get beat up. I mean, everything today almost takes a chip. And so, it does make some sense. I'm not for really corporate welfare, but we need some drawing card to get those type of high-tech jobs more and more back here in the United States.
Frankly, I agree. I'd get on my soapbox much higher and yell much louder if it wasn't for generating some chip business manufacturing here in this country. The biggest risk that we've got in getting to a tiff with China is the fact they're making about 80% of the chips that we depend on. If we get off speaking terms completely with China, bottom line is we're screwed for just about everything that we buy these days.
Yeah, they control a lot of the chip and makers, and so that's not good for us as an economy, for sure. And so anything to reduce our dependence on them is going to be good for us.
Understood. How are we doing as far as earnings are concerned? I've got some weird looking moves on my winner and loser list this morning, and I'm not sure I know why. What's going on this morning?
Well, let's talk about one of the big guys out there, and that's Target. Target had a really good fourth quarter. They beat earnings by about 49 cents a share, came in at $1.89. Now they did have a kind of a letdown as far as guidance going forward. They're saying their full year earnings per share is going to be below what the analysts had expected. And so they have actually earlier, they were in the positive. They've actually flipped to negative right now, Dave. They're down a little over 0.1% right now.
Good Lord. Yeah, it's guidance rules all, no matter how well you do. If you say it might not be as good next quarter, the market's going to punish you this season, aren't they?
They are right now, and because I think everybody is expecting that to happen anyway. And so if anybody comes out and is expecting something different, a good quarter, then that's helping kind of buoy these stocks back up a little bit. We had the Norwegian Cruise Lines reported, and they lost money, but a lot less than expected, like 48 cents less than expected. So they came in, lost $1.04, and so that was a lot better than expected. And so they are not helping themselves any, though, because they're still trading down again because of earnings guidance came in below expectations. They're getting whopped this morning. They're down 6.6%.
I was going to say they're toward the top of my big loser list. When you said they beat the street, I figured it had to be crummy guidance because they look like they're really blowing wind right now.
Hey, the other one we talked about this one not too long ago, is Zoom. They've been in and out of the news. They really benefited during COVID. And so they came in and they beat on the top and bottom line for the fourth quarter. They came out and gave a little lighter than expected revenue guidance, but their earnings guidance. So two different things, right? Revenue was lighter than expected, but earnings guidance was better than expected. So two different numbers there that they look at. And so you've got Zoom up right now, 5.1%.
Wow.
Yeah.
There's a resurgence in staying at home, sometimes not by choice, right?
Exactly. So,
could be.
So that's kind of where we're at right now.
All righty, resetting the table. It was a really, really, really modest green day yesterday, but green is green, and we're happy with that. Any chance we could keep it going this morning? What are we doing 45 minutes early?
Hey, we've been a roller coaster even this morning, Dave. We've been down on the S&P 500 to red. Now we're back to a little bit of green. It's up right now, about 0.2%. We got the Dow up 0.2% as well. The NASDAQ 100 has gone from red up about $15, which is almost 0.15% increase there. So we've got a little bit of green ink. I don't know that it will hold, but at least we should maybe start off in the green. But that could fade away too really quickly. On the other side of the coin, we got silver trading down again this morning, Dave, a little over 0.1%. I think it's up a little bit above where it was yesterday. It's $20.76 an ounce. We've got gold trading down from where it was yesterday, down 0.33% to $1,819 an ounce. And then crude oil's heading up. the wrong direction for you, Dave. Well above 75. It's up 2.5% to $77.56 a barrel right now.
Yeah, that's about $2.50 plus more than was the yesterday morning at this time. So I'm really not happy to see that. The overseas markets, mixed bag in the Asian trend this morning at the close, kind of reflected us. The mainland Chinese markets were up 0.6%, but everybody else is basically frittering around the zero line. Europe is marginally up, but they're somewhat mixed this morning as well, halfway through their trading day. Planning ahead for retirement, I want to know what I'm going to be able to spend when I retire. Phillip, how do I find you to get those plans in place?
That's exactly why we developed the core retirement design to help people design that retirement they always dreamed of, to make sure the risk they have really matches up with the amount of risk they should have in their current portfolio. Give us a call, 863-382-0037. Hey, just a little reminder that you can find the repeat of what Dave and I talk about every day on Facebook at Statler Financial on Facebook. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and 95.3 FM.
Always good information there, too. And then back here tomorrow morning on Light. Phillip, thank you so much. I'll see you then.
All right. Have a great day, Dave.
Take care. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, everybody. I want to thank you for joining us today. I hope your week is off to a great start. Enjoy your day. Join us again tomorrow, same time, same place. Until then, have a great one.